In the middle of the night, Wall Street traders got a message that made their stomachs drop. The United States had just dropped bombs on Iran's nuclear facilities. Within minutes, billions of dollars started moving. Oil spiked, gold spiked, futures on the Dow, the S&P 500, and the Nasdaq all turned red. But here's the part almost nobody talks about. 6 hours later, it was like it never happened. Today, we're breaking down exactly what happened to the American stock market before, during, and after the US-Iran conflict. The real numbers, the real charts, and the one lesson every investor needs to understand about war and money. Let's get into it. To understand the shock, you have to understand where the market was standing before any of this happened. Going into June 2025, US markets were already on edge. Investors were dealing with tariff uncertainty, inflation worries, and a Federal Reserve that hadn't committed to cutting interest rates yet. Then, on June 13th, Israel launched a surprise strike on Iranian nuclear sites. That was the spark. Oil prices jumped immediately. Gold, the classic safe haven asset, started climbing too, and stocks began sliding as investors braced for the United States to get pulled deeper into the conflict. For over a week, the world watched and waited. Would this stay a regional conflict, or would America get directly involved? Then came the weekend that changed everything. Over the weekend, US B-2 stealth bombers carried out a coordinated strike on 3 of Iran's key nuclear enrichment sites, Fordow, Esfahan, and Natanz. This was not a small move. This was the United States military, directly entering a foreign conflict, live, in real time, on a Saturday night. When markets got word of what happened, the reaction was instant. Stock futures dropped sharply. Oil prices spiked as traders started pricing in the worst-case scenario. A possible closure of the Strait of Hormuz, the narrow waterway that roughly a third of the world's seaborne crude oil passes through every single day. Treasury yields fell as investors rushed into safer assets. The US dollar rallied. This is the classic risk-off playbook. When uncertainty spikes, money runs toward safety, and it runs fast. At this point, if you were watching your portfolio that Sunday night, it probably didn't look pretty. But the real story was still ahead. On June 23rd, Iran responded. They launched missiles at a US military base in Qatar. On paper, this should have terrified investors even more. A direct attack on American forces right in the middle of an already tense situation. Instead, something surprising happened. The market went up. By the close of trading that day, the Dow Jones climbed roughly 0.9%, about 375 points. The S&P 500 gained close to 1%. The Nasdaq rose almost 1%. Bitcoin jumped over 4%. And oil didn't spike, it crashed, dropping close to 7% in a single day. Why would markets rally after a literal missile strike on a US base? Because of one detail buried in the news. Iran's retaliation was seen as measured, almost symbolic. It didn't damage the base's core operations. It didn't target American personnel in a way that risked mass casualties. And most importantly, it didn't touch the Strait of Hormuz. Once traders realized the oil supply chain was still intact, the biggest fear on the table disappeared. And when the biggest fear disappears, markets don't just stabilize, they often bounce. Here's where this story gets really interesting for anyone trying to learn from it. 30 trading days after the conflict began, analysts went back and compared prices to where they started, and almost everything that spiked in the first 48 hours had completely reversed. Brent crude oil, which had jumped more than 7% in the first day of the conflict, was actually trading about 0.5% lower a month later than before the war even started. Gold followed a similar pattern, a sharp initial spike, followed by a slow fade back toward normal. Meanwhile, U.S. stocks did what U.S. stocks have historically done after almost every geopolitical shock in modern history. They recovered, and then kept climbing. This is not a coincidence. It's a pattern that shows up again and again. 9/11, the Gulf War, the Ukraine invasion in 2022. Markets hate uncertainty far more than they hate bad news. Once the fog clears, even if the news itself is still bad, capital starts flowing back in. So what's the actual takeaway here? Because this isn't just a history lesson, it's a pattern you can actually use. Number 1. Initial panic is often the market pricing in the worst-case scenario, not the actual outcome. Prices move on fear before they move on facts. Number 2. Watch the specific risk, not the headline. In this case, the real risk was the Strait of Hormuz. The moment that risk was taken off the table, the broader panic didn't matter anymore. Number 3. Historically, wars are terrible for people, but they have rarely been long-term disasters for the U.S. stock market. That might sound cold, but it's how the data has played out again and again. None of this means you should ignore geopolitical risk. It means you should understand it well enough to not make emotional decisions when the headlines are the scariest. So next time you see a breaking news headline about markets plunging because of some conflict overseas, take a breath before you panic sell. History shows the first reaction is rarely the final one. If this kind of real market breakdown is something you want more of, hit subscribe, because we're going to be covering exactly how global events move American money week after week. Thanks for watching Capital Craft. I'll see you in the next one.